Good evening, everyone, and welcome to Wednesday evening's seminar. Tonight we are looking at insurance and contract administration, what you need to know. And it is Jon Sharp, consultant of the Silver Shamings Ash, who'll be telling us exactly what it is we need to know about this topic. As always, if you've got any questions for Jon, please use the Q&A tool in the bottom toolbar to put those questions to him, and he will answer as many as he can at the end of his presentation. If there's something that occurs to you as we're going through that you think you'd like to ask Jon directly, please always feel free to email him on jonsharp@silverllp.com. That's Jon, Jon, sharp@silverllp.com. Okay, housekeeping stuff over. Jon, it's over to you. Tell us all about insurance and contract administration, please.
Well, thank you very much, Julie. Lovely to see you as always. Good evening, ladies and gentlemen. Insurance and contract administration, what you need to know. I shall just press on, ladies and gentlemen. That's me. You don't really need to know too much about it. All these details are on the website. But we'll run through the agenda. I have to say now that I give full credit to Phil Lamb at Clear Insurance. He helped me put the second half of this presentation together, and it would be wrong of me not to give him credit, and indeed Clear for allowing me to have his assistance. So first of all, we'll just run over some basics, and then we'll move on to some more complicated issues. We need to look at the three important principles of insurance: the reform of the Marine Insurance Act of 1906, the Third Parties Rights Against Insurers Act of 2010, CIDRA, not cider, I wish it was, Insurance Act 2015, warranties and fraud, case studies, construction insurance, and top tips for getting your claim paid. There are three important principles of insurance, and these, I think sometimes people forget these. These are enshrined in all the legislation and in case law. So the first is, irrespective of the changes in the law, insurance is a policy of indemnity. It's designed to put you, the insured, back into the position that you were in before the insured event. So not in a better position, not in a worse position, but the same. There are one or two exceptions to that in domestic policies, new for old, etc. But for most commercial policies, that is the principle. And remember as well that insurance is a contract between the insured and the insurer. It is a contract in the same way as any other contract you enter into. So if you enter into a contract with your if you're a construction professional and you enter into a contract with a subcontractor, it's no different. This is exactly the same. And your aim as an insured should be to make sure that you have proper, full, and adequate insurance for the type of business that you are conducting. Proper insurance, despite its somewhat tarnished, I think I'll leave it at that, reputation at the moment, can save businesses. So just a little history. Insurance in this country was more or less governed by the Marine Insurance Act of 1906 for many, many years, and it served us well. But the Law Commission, instead of reforming something sensible like the Consumer Credit Act, thought it was archaic, unclear, and unfair. Why is insurance generally important to the UK? Well, the London insurance market still has global influence. It's the third largest insurance market in the world. So instead of replacing the Marine Insurance Act 1906 with one act, it replaced it with three. The first is the Consumer Insurance Disclosure and Regulations Act 2012, the famous CIDRA. The Third Parties Rights Against Insurance Act 2010, which wasn't enacted in 2016, and the Insurance Act of 2015, which applies to most commercial businesses. Oh, and just as an afterthought, they added a little clause in the Enterprise Act as well. Right, the old law was that contracts are vermi fidei. Nice little bit of Latin there, but it means utmost good faith. And all matters relating to the risk in any way had to be disclosed, however irrelevant, frankly. And underwriters could void the policy for non-disclosure and frequently did so. So warehouse example number one, the flood and no fire alarm. Yep. So say you own a warehouse, this is under the old law, and it floods. Yeah. But in your contract of insurance, you had warranted that the fire alarm would be working. When the loss adjuster comes round, he says, I just want to test your fire alarms. And lo and behold, they're non-functional. Now, that would not have prevented the damage the warehouse suffered in any way, shape or form. But nevertheless, because it was a warranty under the old law, insurers could avoid it. It's still the case today, however, that most policies that do not pay out a claim do so because of non-disclosure. Now, the Third Parties Rights Against Insurance Act 2010 is of interest because a party who has a claim against an insolvent insured can cut through and recover relevant compensation from the relevant insurer. So, put yourself in the position that you are a subcontractor and the main contractor goes bust. And let's just say he goes bust because he made a major error and basically he's ruined. In a building, he built something wrong, he's ruined. But he was covered by his insurers for that error. Now, before this act, you as a subcontractor could do nothing about it. But now you can. You can stand in the shoes of the contractor and say, the contractor owed me money. Now, I know he has the benefit of insurance, which covers him for these events. I am claiming on the insurance in his place. It's called stand-in right. Okay? However, all that said, I don't know of any case yet where it's actually happened, but the potential's there, and it's always worth remembering. CIDRA, this was law from 2015. I do wish it was CIDRA, as I've said. Unfortunately, it's not. But it only applies to consumer insurance contracts. So probably pretty irrelevant for all those who are attending today. And by consumer contracts, they mean bought by individuals wholly or mainly unrelated to trade, business, or profession. So it's your motor insurance, your contents, your personal phone insurance, etc. Yeah, that's governed by CIDRA. But the Insurance Act 2015, introduced in 2016, applied to all commercial policies commencing on or after the 12th of August 2016. It introduced a new duty for all non-consumer insureds to make a fair presentation of the risk. And it reduced the insurer's remedies for breach of the duties of fair presentation. It was supposed to make it more difficult for insurers to avoid paying claims. So what do we mean by fair presentation of a risk? Well, it's your duty to provide all relevant information to insurers in respect of the risk that you want to have insured. Now, in the old days, one person in a company would be responsible for placing the insurances, and that would be it. And he would fill out the proposal forms, submit them, and wouldn't really bother anybody else with it. Not the case anymore. You must now involve all relevant senior management when compiling information for insurers. So particularly in relation to construction, you might need to speak to all your site managers to find out whether or not there's any particular problems with this site, etc. Also, you've not only got to state material circumstances that you know of, but ought to have known of, bearing in mind the nature of your business and after having conducted a reasonable search. And you must provide the information to your insurer in a reasonably clear and accessible manner. Senior management, well, that's anyone, as is probably fairly obvious, who has a key role in making decisions on behalf of the company. Now, as I said, that may obviously include main board directors, managing directors, etc. But it may also be your site managers, your operations managers, your logistics managers, who make decisions on a daily basis, very often quite major decisions, without necessarily consulting with the main directors of the company. What do we mean by material circumstances? Anything that would influence the judgment of a prudent insurer when he decides whether to accept the risk, and if so, on what terms. Known or ought to have known, basically, commonly available information that affects your business. So if there's a new set of building regulations being introduced, you are expected to know about them, and you are expected to inform your insurers about them. Reasonable search, well, that does depend on the nature of your business and the type of insurance that you wish to buy. But if you're placing your motor business to cover all the motor vehicles associated with the company, then the logical person to speak to would be the guy in charge of your motor vehicle fleet. He will have the information. You wouldn't go and speak to the person who's in charge of catering, for example. Reasonably clear and accessible? Yes, well, that means you don't shove all the information in a carrier bag and say, here you are, insurer, help yourself to that lot. But also, you mustn't hide key facts amongst large amounts of wholly irrelevant material. Now, for the most part, this doesn't matter. If you use the services of a professional broker, he will provide you with, excuse me, ladies and gentlemen. He will provide you with a proposal form, and as long as you answer that honestly and truthfully, or to the best of your ability, then you shouldn't have any problems. Now, the Insurance Act 2015, introduced in 2016, if the insured fails to give a fair presentation of the risk, and also equally, the insurer may avoid the policy as follows. If the non-disclosure was deliberate or reckless, you can still avoid the policy and keep your premium. So, for example, if you regularly have men working at a height of over 100 feet, yet you said on your proposal form that there is never any working over 25 feet, that's probably deliberate and probably reckless. And the insurer, under those circumstances, will avoid the policy and keep the premium that you've paid. Not have written the risk? Well, the insurer can avoid the policy, but he has to return the premium. So, if you, for example, grossly underestimate your turnover, or grossly underestimate, or do not inform insurers that in fact you're involved on multinational projects, but you've just said, oh, we only do domestic projects, then yeah, he's likely to say, well, if you told me you were doing multinational projects, I wouldn't have written the risk. In respect of all other breaches, so warranties, etc., if the insurer were to have imposed additional terms, they're imposed from inception. So if he does say, well, actually, okay, I will write your your business, even though you are conducting business on a multinational scale, but I'm going to impose the following terms, and I'm going to charge you a higher premium. Sure, his option can do that. Now, the Insurance Act 2015, as well as what's called a default scheme, your insurers can contract out of it, and watch out for this. But if they are going to impose a term in your policy that is disadvantageous to an insured, they must take steps to bring it to the insured's attention and ensure the term is clear and unambiguous. I've put a note there at the bottom, probably not suitable for reinsurance contracts. I won't bore you with what reinsurance is, so you can ignore that safely. Warranties and fraud. Any term that seeks to turn information provided by the policyholder when the policy was purchased into a term of the insurance policy will now have no effect. So if there is a breach of warranty, the policy is suspended while the insured who is in breach remedies that breach, but restarted when the breach is remedied. So, very simple example. You have said to insurers that you have that you always ensure that all your workmen wear helmets when on site. But due to COVID-19, there's a shortage of helmets. You haven't got enough helmets to go around. Well, I'm afraid to say insurers could have their option say, well, we're not insuring you until such time as you have got enough helmets to go around. Yeah. Now, let me look then. Let's take warehouse example 2, the flood and no fire alarm. Well, in the old days, as I said, that would tend to have avoided the policy. Now, no, it wouldn't. The fact there is that if you have a flood, having a fire alarm makes absolutely no difference whatsoever. It wouldn't have prevented the flood. It wouldn't have alerted what flood. It's completely erroneous. And if underwriters now tried to rely on the lack of a working fire alarm to avoid the policy, they would get away with it. Fraudulent claims, always beware of fraudulent claims. Insurers now have a variety of methods in which they track claimants, and they know who the fraudsters are, and they're getting extremely sophisticated about it. But if it is a fraudulent claim, then the entire claim is forfeit, so they won't pay you any money, and the insurer keeps the premium. However, the insurer remains liable for any genuine claims prior to the fraud, but with the option to terminate the policy from the date of the fraud. Ted Baker and AXA, an interesting case, but it just really highlights the question of excesses in your policy. The general rule is that if you have a higher excess, your policy will go down. Ted Baker and AXA, though, is a stark warning that you can get this horribly wrong. I'll just briefly outline the facts. There was a gentleman called, ironically, John, and he went about, since about 2002 to 2010, systematically stealing Ted Baker clothing. He wasn't caught, despite Ted Baker bringing in private detectives, and they also blamed at one stage their new software, which was supposed to reorder automatically. They never found them. It was only when a gentleman was leaving just at the end of his service, they were having just an interview with him to say thank you very much and the rest of it. So there's some very odd things going on in the car park. That alerted them, and they eventually managed to arrest John, but not until he'd stolen about £2.1 million worth of goods. Anyway, I won't bore you with the details on this slide in particular, but suffice to say, AXA denied liability. They lost on that. But when it came to the question of quantum, Ted Baker also lost. The judge holding it was impossible to find any single loss in the series of thefts which exceeded the policy excess. Even though the judge reached the finding with no great enthusiasm, the policy clearly had theft, and even on the defendant's own case, AXA's own case, the losses amounted to 2.1 million. Unfortunately, because their excesses were so high, they recovered very, very little. So beware. I'll let you read the next slide to yourselves. Yeah. The only other point, sorry, just on number 5, that case decided, is that an insurer or reinsurer does have a duty to spell out to the insured or reinsured that its actions or inactions during the claims process may well jeopardize the claim. So, for example, if you make a claim and the insurer says, we want to see your management accounts for the last 5 years, and you go, we're not giving them to you, what has that got to do with our claim in relation to the flood of our warehouse? And you refuse to give it. Insurers now have to say to you, look, by not giving us this information that we've requested, this may well jeopardize your claim. They can't just remain silent about it. One of the issues in Ted Baker was that right at the start, Ted Baker had asked for a management accounts, and Ted Baker just said, well, it's irrelevant. What do you want to see him for? Well, instead of insurers then saying, well, look, if you don't, it might jeopardize your claim, they just simply kept quiet and tried to produce a rabbit out of a hat at trial. It didn't actually save them, but the judges have made it clear that that behavior by insurers is no longer acceptable. Construction insurance, well, compulsory insurance is by law. There is only one. That's employer's liability insurance. Under the JCT, of course, though, you need to have public liability insurance or risk insurance, and be mindful of the design exclusion. Remember, it can be brought back for new build contracts. I'll let you read that slide for yourselves, but remember in car policies that it depends on the type of cover that you have. Okay? So make sure, this goes back to a point that I repeat time after time whenever I'm giving talks on insurance, to read your policy wording. This is the big, thick booklet that you should have. It will be anything between 60 and 120 pages long. That's your contract with your insurer, and you need to read it. So make sure, even if you're using a professional broker, that when you receive your policy wording, that it's read, and make sure that it covers the business for the type of risks that are likely to give rise to a claim. So, for example, just on that, DE1, for example, if you've got that in your contractors all risk, it's a total exclusion of all loss or damage. Make sure that you haven't got that one. And the others escalate in terms of how much cover you have. What other insurances should you all be thinking about taking out? Well, directors and officers. This protects the directors and officers of the company against any accusations of wrongdoing, whether it be by our friends at Health and Safety or anywhere else. Cyber attack. Since COVID-19 and lockdown, insurers are reporting a 40% increase in cyber attacks and subsequent fraudulent activity. Are there key man within your organization that really the business cannot do without, or cannot do without at the present time? If there is, you might want to think about taking out key man insurance on it. Pollution. Well, in your car policy, some policies cover cleanup costs up to 1 million. You can buy pollution one-off policies, one event that gives you sudden accidental cover. And you can, of course, buy site-specific pollution policies, but they are very, very expensive. Also, remember to buy professional indemnity due to care to others, and avoids the issue of whose design error it was in a design and build contract. So, conclusion of this part, make sure you comply with your disclosure obligations. You can't actually provide your insurer with too much information. Mind your excesses. Is the trade-off for a lower premium worth it? Can your business afford to pay a higher excess if the worst comes to the worst? Read your policy wording. I cannot stress this enough. Make sure it covers you. It is not an interesting read. There is no doubt that it is probably one of the most boring books or bits of paper you'll ever read in your life. But if you don't read it, insurers know it off by heart and backwards and will quote it back at you. If you make changes to your business during the course of the year, don't assume that you will still be covered. You need to notify your insurers and say, we are now embarking on a new type of work and it's going to involve this. Beware of the loss adjuster. As I said right at the beginning of this, it is a policy, insurance is a policy of indemnity, designed to put you back into the position that you were before the event, not better and not worse. Okay? That's why they have loss adjusters, to make sure you're not over-egging the pudding when it comes to making a claim. And remember, until the cover is confirmed, you must act as a prudent uninsured. So you must do everything in your power to minimize the loss that you're going to be claiming against your insurer. So that means if your warehouse floods, not leaving all the packages floating in the water, it means getting the packages out. They may still be ruined, but insurers may say, well, you could have done more to try and get the salvage value. Just one caveat, I mentioned earlier the Enterprise Act. Everyone is familiar with insurers dragging their feet. It is fairly common knowledge that they do when it comes to paying out and making claims. And the government was aware of this and introduced a clause in the Enterprise Act which said that if an insurer, after a period of 6 months, on a straightforward claim, has not paid you, and you have to, for example, take legal proceedings against it, then you can also now claim damages. So they are just dragging their feet on a straightforward claim, you can now claim damages. Has there been one reported case in it yet? No, not that I'm aware, but it's there and it may well be worth remembering. That, ladies and gentlemen, is all I was about to say this evening to you all. If you have any questions, then please do not hesitate to contact me.
Thank you very much, John. We do have one question that came in earlier, which was around selecting. Let me just make sure I get the right wording. What are the consequences of COVID-19 on selection of insurance of the works?
Just repeat the question, Julie, just so I understand.
Sorry,
it correctly.
What are the consequences of COVID-19 on selection of insurance of the works?
Okay, the consequences of COVID-19 and your selection of insurers. Well, just about every insurer since COVID-19 has now done two things. One, it will have increased its premium. And secondly, without any shadow of a doubt, it would have reduced the cover that it's prepared to offer. This would have been across the board. It doesn't matter whether it's a contractors or risk policy, whether it's a professional indemnity policy, or in fact, any other policy. Insurers, when they get hit with major losses, have two reactions. And this set of circumstances is no different to any other. They have simply increased the premium and reduced the amount that they cover you for. So, when it comes to selecting insurer, it's probably now more important than ever to speak to a broker. They will know which insurers are still prepared to offer the widest possible cover. There are still some insurers that are offering fairly decent cover for relatively modest premium if you're conducting works that are of a normal run-of-the-mill construction contract. But whatever you do, don't ever mention to insurers the word cladding, because they will run a mile at the moment. So I think the advice is, no matter what type of insurance you're trying to place at the moment, you need to see a broker. They will know the widest coverage that you will obtainable at the present time. But I can tell you now that it will be drastically reduced from what it was even a year ago. So you need to be very careful about that. And you'll probably be charging you twice as much premium as a minimum.
Ouch. Okay.
Yes, ouch. And it's not going to get any better anytime soon either.
No, definitely no improvement. Okay, who usually takes the employer's liabilities insurance, employer or contractor?
Well, it depends on the wording of the contract between you, the two of you, but it's In my experience, it's something like 50-50, but it doesn't really matter. The one thing that is still one of the very few things that is actually still relatively cheap is employers' liability policies. They are very rarely claimed on. One of the nice good things, or joking aside about the health and safety, is safety on construction sites has is so vastly improved than even since 2000. That accidents are few and far between, and premiums are for that pretty low still. So to some extent, it doesn't really matter. But check the policy, so check your contractual wording as to who is responsible for it. It doesn't really matter who picks it up. It is not a big ticket item comparatively.
Right. It's more important that it is picked up as opposed to who picks it up.
It's more important, yes, that it is picked up. Someone's got to have it because otherwise it's illegal. But sometimes employers do it. They've got a blanket policy anyway, and they just say, well, we'll just add it to that. But equally, contractors sometimes, we'll do it. We've got a blanket policy. We'll just add it to that. It's not, as I said, a majorly expensive item just at the present time, thankfully.
Okay. Someone else is asking, could you advise on the minimum insurance and levels for self-employed consultants?
Depends what type of consultancy you're doing, to be honest. If you're a self-employed consultant advising on a major construction project and your advice is going to be crucial to the design of the project or what works are being carried out, etc., then you probably need as much cover.
QS, apparently. Sorry, someone.
QS.
Yeah, it's QS.
Right. Well, I think from memory there are specialist self-employed QS policies out there, but the minimum cover that I think you will probably need is probably something between 1 and 2 million. It depends on the project size that you're working on. Now, because it's a professional indemnity insurance policy, it will not be cheap at the moment. It may be slightly different for quantity surveyors, but certainly for solicitors, it's hugely expensive, and it's certainly the same for architects, everybody else. And professional indemnity premiums are only ever going to go up. But I would have thought the minimum cover that you would want is between 1 and 2 million. Barristers typically have to carry 2.5. We have to carry 2. Sorry, we have to carry 3. And I would have thought the minimum, because it helps you when you're pitching for work as well, if you can say, I'm insured for X. Yeah. It does help. We often get asked, Julie, as you know, how much professional indemnity does the firm carry? It's nice to be able to say we carry X. It will be no different. If you're a self-employed person pitching for quantity surveying work, it will be helpful to say, I am insured for X amount of money.
Okay. Well, that seems to wind up our questions, unless anyone else has got something they'd like to throw in at the last minute. So thank you, as always, John, for your time. Oh, there's just one more coming in there. Hold on.
No problem at all.
Here we go. One of my subcontractors is unable to renew their PI insurance due to the increase in premiums. JCT D&B 16 notes that they are able to maintain such insurance providing it is available at commercially reasonable rates. Comparing my subcontractor's renewal premium against what they've paid this year, what uplift would you deem as commercially unreasonable?
Well, I would say I need to be slightly careful what I say now, just at the moment. Some of the increases that are being put through at the moment are, in my view, unreasonable. I've known a number of brokers for years. I've known one gentleman in particular at Lonmar who I basically grown up with. We met each other when we were 23, and we've known each other ever since. And he says very, very, thank you, Julie. I don't look that old, do I?
No.
And he says it's the worst insurance market that he's ever known. And he told me a story that 3 years ago, one of his construction clients was paying a premium of somewhere in the region of 100,000 for pretty decent contractors all risk cover. He's just renewed it this year, and it's 800,000. Now, in my view, and it's only my view, I stress this, that I think that is commercially unrealistic.
Yeah.
Doubling, tripling, yeah, but 8 times, I think that does make it. But I'm equally bound to say, where does that leave you under the JCT? I don't know, because you have to have some form of insurance cover. What do you all do? It just simply says, and that's what the JCT contract says, it's commercially not viable. Is it commercially available? Well, yes, it is, but at what cost? It's a very difficult one. It's a very good question. And I wish I could give an absolutely succinct answer, but I'm not sure what the solution is going to be. But one thing I can say is that this problem is not going to go away. It is not going to be something that is just around for this year because of the review of Lloyd's and the lack of capacity, because of the 737 MAX situation, because of the likely outcome of Grenfell, and now because the insurers have found that they are liable for COVID-19 when they couldn't say, when they all said, oh, it's nothing to do with us. Premiums are just going to continue to rocket. So I do not know what the solution is, but it's a difficult question at the moment. Very difficult problem.
Okay. Someone else was saying, is it common that subcontractors are struggling to get a performance bond? It's becoming very typical on their projects.
Yes, it is. Again, it's all to performance bonds. Yeah, again, it's all to do with the tightening up of the insurance market. It's all to do with the fact that they're becoming very, very risk averse again. Gone are the days, and long gone will be the days when they would, alter policy wordings for you, etc. They stick to their policy wording now on very, very more rigid terms. It's the same with performance bonds. The number of questions that are going to be asked now, they'll be looking at solvency more and more and more. And so they will not be as readily available as they were, say, 3 years ago, without any shadow of a doubt. If you can get them at all, I would have thought there's still a market for it. But again, you'll be paying probably half again of what you used to pay.
Nothing ever gets cheaper, does it?
No, unfortunately not. No. Still,
Okay.
at least you can get a drink in England. You can't get one up here in Scotland, can you?
And on that controversial note, we will leave you, Mr. Sharp. Thank you again for answering the questions. Thank you, everyone, for joining us and for asking some interesting questions there. As we previously said, if there is something specific you didn't particularly want to ask in an open forum, please feel free to email Jon Sharp, that's Jon Sharp, at silverllp.com, and he will happily answer what he can for you. In the
yes,
meantime,
ladies and gentlemen, yeah, I would be delighted to do that. If you haven't got my email address, then just email Julie and she'll make sure that I answer them. Otherwise,
gets answered.
She'll make sure that I answer the question.
We will see everyone hopefully tomorrow. Jon, we will see you next week, I believe. And,
yes, I think you will.
Yeah, and thank you very much for your time. Have a good evening.
No problem
everyone.
at all. Good evening, ladies and gentlemen. Stay safe and well.
We'll talk to you soon. Take care.
Take care.